Second home, vacation property ownership, personal versus corporate ownership. The decision to own a second home personally or through a corporation in the United States involves a complex trade-off between simplicity, tax benefits, and liability protection. Personally holding a property is the most common route for those seeking the lowest administrative burden and the easiest access to traditional mortgage financing. When you own a property in your own name, you can often qualify for more favorable interest rates and lower down payment requirements compared to business loans. Additionally, personal ownership simplifies your annual tax filings, as the property generally falls under standard individual reporting rules. However, this simplicity comes at the cost of direct exposure. Your personal assets are potentially at risk if a guest or contractor is injured on the premises and decides to sue. From a tax perspective, personal ownership is often superior for homes intended primarily for family use. If you sell the property after holding it for more than 1 year, you benefit from long-term capital gains tax rates, which are significantly lower than ordinary income rates. Furthermore, if you eventually convert the second home into a primary residence and meet the IRS residency requirements, you may become eligible for the Section 121 capital gains exclusion, $250,000 for individuals or $500,000 for married couples. In contrast, properties held within a C corporation are subject to double taxation, once at the corporate level when the property is sold, and again when proceeds are distributed to shareholders. Corporations also cannot claim the primary residence exclusion, potentially leading to a much higher tax bill upon disposition. For properties that will be rented out frequently, an LLC, limited liability company, or S corporation can offer a middle ground by providing a legal corporate veil. This structure separates your personal wealth, such as your primary home and retirement accounts, from liabilities arising at the vacation property. If a lawsuit occurs, the claimant's recovery is generally limited to the assets held within the entity itself. While this protection is robust, it is not absolute. Owners must maintain strict corporate formalities, such as keeping separate bank accounts and avoiding the commingling of personal and business funds. If these boundaries are blurred, a court may pierce the corporate veil, nullifying the liability protection you sought to establish. Operating a vacation home through a corporation, or LLC, introduces significant administrative and operational costs. These include initial formation fees, annual state filing fees, and the cost of preparing a separate business tax return. Additionally, obtaining a mortgage for a property owned by an entity can be difficult. Many lenders will require a personal guarantee from the owner, which partially undermines the intent of separating personal and business liabilities. Insurance can also become more complex and expensive, as a standard homeowner's policy may not suffice for a corporate-owned property, especially if it is being treated as a commercial rental enterprise. The personal use of a corporate-owned vacation home creates unique tax traps that many owners overlook. If a corporation owns the property and allows you to stay there rent-free, the IRS may characterize the fair market rental value of your stay as a constructive dividend or taxable compensation. This means you could be forced to report the value of your own vacation as personal income, while the corporation may not be allowed to deduct the related expenses due to strict vacation home rules. These rules limit expense deductions for units used personally for more than 14 days or 10% of the total rental days, making it difficult to achieve the tax-saving business expense deductions many owners hope for. Estate planning is a final, critical consideration that often tips the scales toward entity ownership for high-net-worth individuals. Transferring a property to heirs is often more seamless when the home is held in an LLC or trust, as it can help avoid the costly and time-consuming probate process, particularly if the home is located in a different state from your primary residence. Ownership can be transferred by moving membership interests in the entity rather than deeding the real estate itself, which can simplify the transition between generations. However, for most average homeowners, the long-term tax advantages and simplicity of personal ownership usually outweigh these advanced legal benefits. We welcome you to subscribe to our YouTube channel for more informative videos on investments, real estate, and taxes. Thank you.